All right, so welcome everyone joining us for another deep dive, and this time we're going to unpack everything that happened in global and Kenyan financial markets during the week of March 24th to the 28th.
Sounds good.
Yeah, and our main source is going to be this super detailed podcast transcript we got called Market Color, and I think the goal is to kind of pull out what matters most from all its info.
Yeah, cut through the noise.
Yeah, exactly. Yeah. Without overwhelming everyone. So let's kick things off by looking at the big picture, the global markets.
Yeah.
What's the overall vibe?
Yeah, for sure. I mean, right away, what stands out is this kind of weird situation happening in the U.S.
Yeah.
You've got key economic indicators that are all over the place, not really moving in the same direction.
Totally. Okay, let's dive into inflation first.
Right.
So the February core PCE price index came in higher than expected, right? Up 0.4% for the month, 2.8% year on year.
Okay.
And I know people listening are probably familiar with this, but just to clarify, the core PCE is the Federal Reserve favorite way to measure that underlying inflation because it strips out the volatility of food and energy prices.
Yeah.
Gives a clearer picture. And this 0.4% monthly jump, that was the biggest we've seen in over a year.
Yeah.
A bit above what those forecasters were predicting.
Huh, interesting.
So, what does this really mean for us? What's the significance of this?
Okay, so the main takeaway here is that this inflation, it's sticky at 2.8% annually.
Yeah.
That's still pretty far off from the Fed's 2% target. Think of the core PCE as the Fed trying to, check the temperature of inflation without getting thrown off by those sudden changes in food and energy prices.
Oh, okay, yeah.
It's like a more stable reading for them to decide if they need to adjust interest rates, to cool things down or heat things up. And this higher than expected reading, it's basically suggesting that the Fed might have to keep those interest rates higher for longer, and that could delay any plans to cut them.
That makes total sense. Okay, now here's where it gets really interesting, right? At the same time that inflation is being all stubborn, we also saw this huge drop in U.S. consumer confidence.
Really?
Yeah, the March Consumer Confidence Index tanked, down over 7 points to 92.9. That's the fourth month in a row it's dropped.
Wow.
And get this, the outlook for future economic conditions, that fell to its lowest point in a decade.
Okay, so remind me, what does this index really measure, and why is this drop so significant when inflation is still up there?
Right. So the Consumer Confidence Index, it basically gives us a glimpse into how optimistic or pessimistic people are feeling about the future of the economy. It looks at things like job prospects, how businesses are doing, and how much income people expect to have.
Gotcha, yeah.
So when we see a massive drop like this, especially in how people view the future,
Right.
It's a pretty big warning sign that they might start being more careful with their money, delaying those big purchases.
I see.
Which then has this ripple effect through the whole economy, this low future outlook. It could be a sign that spending might slow down.
Okay, interesting.
Which makes the next piece of data even more puzzling.
What's that?
So, despite this growing pessimism, consumer spending actually accelerated in February. It rose by 0.4%. And personal incomes also jumped up 0.8%.
So hold on, people are feeling down about the future, but they're actually spending more and earning more right now.
Yeah, exactly. What do we make of this? Seems like a bit of a contradiction.
You're right. This is a crucial point, and it might mean things are a little shaky in the short term.
Okay.
Typically, when confidence drops, we see spending drop too. But this weird behavior, it might suggest there's a lag effect. Maybe current spending is reflecting optimism from the past, or perhaps savings that were built up earlier. It's also possible that the very same inflation worries we were just talking about are pushing people to spend now before prices potentially climb even higher. And the fact that incomes are rising too could be providing, temporary support for this continued spending.
Right.
However, historically, these kind of mismatches between confidence and spending, they often happen before major economic shifts.
Oh, okay.
So the key question for you listening is whether this spending spree can last given how pessimistic everyone's feeling.
Right. It really feels like we're getting mixed signals from the economy. And all of this seems to be feeding into these growing worries about a possible recession in the U.S.
For sure.
The Market Color transcript highlights this concern coming from those consumer sentiment surveys, and it rightfully points out that if the U.S. sneezes, the rest of the world catches a cold because of how central the U.S. is to the global economy.
Exactly. A slowdown, or even worse, a recession in the U.S. that would have ripple effects everywhere, hitting global trade, investment flows, even overall economic growth. Many economies, including Kenya's to some extent, They depend heavily on U.S. demand for their exports and are influenced by what's happening in U.S. financial markets.
Okay, so we've talked about inflation and consumer confidence. Now, switching gears a bit, we have to talk about President Trump's announcement
Oh, yeah.
about this significant 25% tariff on all cars manufactured outside the U.S. set to kick in on April 2nd.
Big news.
Yeah, this feels like a really major policy shift.
It is. It's a huge move that could have some far-reaching consequences. Think about it. A broad tariff like this on a massive industry like automobiles that has immediate impacts, and we already saw it with auto stock taking a dip.
Right.
But beyond that initial reaction, these tariffs could completely reshape those global supply chains. For you, listening, it's worth thinking about how this might hit the prices of the things you buy and the competitiveness of different industries worldwide.
Yeah, that's a good point.
You know, in the past, these broad tariffs have often led to retaliation from other countries, escalating those trade tensions and ultimately hurting global growth.
Right, okay. So that paints a picture of what's happening in the U.S. Now, let's hop across the pond to the U.K. It seems like the inflation story there is a bit different.
Okay.
The annual inflation rate in February actually dropped a little to 2.8%, down from 3% in January. And good news, it was below what economists were expecting. Core inflation also dipped slightly.
Interesting.
So what does this tell us about the UK economy?
Well, this easing of inflation in the UK, that's probably a sigh of relief for the Bank of England.
Yep.
You know, inflation's still above their target. But this slowdown suggests that some of those price pressures might be letting up a bit.
Okay.
This could give them a little more wiggle room when they're deciding what to do with monetary policy in the future. However, just like most economies, the UK isn't immune to global trends, so they'll be keeping a close eye on what's happening in the US and other parts of the world.
Makes sense. Now, coming back to Wall Street, the end of the week saw this pretty huge stock market sell-off on Friday. The market-colored transcript points to the uncertainty around U.S. trade policy, those ongoing inflation worries, and the growing fear of a recession as the main culprits.
Right.
It even mentions that the Consumer Sentiment Report showed the highest long-term inflation expectation since 1993. That's a big jump in what people expect prices to be in the future.
Wow, that is significant. That spike in long-term inflation expectations, that's the part that really worries me because it can actually become a self-fulfilling prophecy.
Oh, how so?
Well, if people think prices are going to keep going up way into the future, they might demand higher wages now and be willing to pay more for stuff, and that can actually push inflation even higher. So this kind of outlook, it definitely spooked the markets.
Yeah, for sure. And the numbers really show that anxiety. The Dow Jones Industrial Average, that was down almost 1% for the week, dropping over 700 points just on Friday alone. The S&P 500 down 1.5% for the week, and the NASDAQ Composite, that really got hammered, down 2.6% for the week with a massive plunge on Friday. It's even on track for its worst month since December 2022.
Oof, that's rough.
Yeah, it's a big drop in investor confidence.
Totally. This kind of widespread sell-off, especially happening so intensely at the end of the week, it shows just how nervous investors are about this whole mix of negative stuff. The possibility of trade wars, that stubborn inflation, and the looming threat of a recession.
Right.
And, you know, the tech sector, which is often seen as more vulnerable to economic uncertainty and the prospect of higher interest rates, that really bore the brunt of the selling pressure.
Okay, now let's shift focus to the government bond market in the U.S. Despite those still high inflation numbers, Treasury yields actually fell on Friday. The 10-year Treasury yield dropped by about 12 basis points, and the 2-year yield fell by 9. That seems kind of counterintuitive given the inflation data.
It does, right?
So what's going on there?
It's actually quite interesting. This drop in yields, even with inflation still sticking around, it could be signaling a few things.
Okay.
It might mean that investors are starting to think the economic outlook is weakening, and they're looking for the relative safety of government bonds.
Right. Makes sense.
Those are usually seen as less risky than stocks during uncertain times. It could also just be a technical adjustment within the bond market itself. But it's super important to remember, as the transcript points out, that the core inflation rate is still way above the Fed's target.
Yeah.
Which means that monetary policy will likely stay tighter for longer than some people might want, and that would usually push bond yields up, not down.
So it's a situation we need to watch closely.
Absolutely. Oh, and just to clarify for everyone, a basis point is 1/100th of a percentage point. So a 12 basis point drop, that's 0.12 percentage points.
Okay.
And another thing to remember, bond yields and prices, they always move in opposite directions. When yields go down, bond prices go up and vice versa.
Got it. Now, let's move on to the crude oil market. It was on track for its third weekly gain in a row, but then it dipped a bit on Friday. Again, this seems to be tied to those worries about U.S. tariffs potentially triggering a global recession and lowering demand. But both Brent and WTI crude still ended the week with gains. So how are these global economic concerns affecting the oil market right now?
Well, the oil market, it's super sensitive to what people think is going to happen with global economic growth.
Right.
Tariffs that could lead to a trade war and then a recession. That would obviously lower the overall demand for oil, and that's why we saw that dip on Friday.
I see.
But the fact that prices still went up for the week overall suggests that those underlying supply and demand factors were still providing some support for most of the week.
Okay, that makes sense. And finally, in our global markets roundup, let's touch on precious metals and cryptocurrencies.
Rah.
Gold had a big surge, hitting a record high on Friday as investors rushed to safe haven assets amidst those trade war fears.
Yep.
Bitcoin, on the other hand, was pretty much flat for the week, but it's still heading for its first three-week slide of the year. So what's driving these kind of contrasting performances in these alternative asset classes?
Okay, so the surge in gold, that's a classic example of a flight to safety. When there's a lot of economic uncertainty and geopolitical risks,
Yeah.
gold is often seen as a reliable store of value. The worries about tariffs and a potential trade war are definitely fueling this demand, especially because gold tends to do well in environments where interest rates are low or even negative
Sure.
cryptocurrencies. Even though they're sometimes seen as alternative assets, they've often traded more like riskier assets like stocks, as we saw with the overall decline this past week.
Right.
Bitcoin's relative stability, despite all the market jitters, might mean that some investors still see it as a long-term store of value. But that three-week slide, it shows that there's still a lot of caution in that market.
For sure. Okay, that gives us a good overview of the global financial landscape for the week. Now let's turn our attention to Kenya. What were the key things happening in the Kenyan financial markets during this same period?
Okay, so in the Kenyan foreign exchange market, the shilling was actually pretty stable against the US dollar. The official CBK rate, it barely changed from the previous week.
Interesting.
And similarly, the exchange rates against other major currencies like the British pound and the euro, as well as regional currencies like the Ugandan shilling, Tanzanian shilling, and Rwandan franc, they all stayed pretty steady too.
So short-term stability seems to be the story for the shilling. But the market color transcript does mention some persistent long-term concerns, especially about the country's huge national debt.
Exactly. While the immediate outlook suggests the shilling will probably keep trading within this range for now, the underlying long-term fundamentals, they're not as optimistic. The national debt, which is now over 70% of the country's GDP and eats up a big chunk of tax revenues.
Wow.
That remains a huge vulnerability for the Kenyan economy. This level of debt also makes Kenya super sensitive to external economic shocks like rising global interest rates or a downturn in those key export markets.
Right.
And it can crowd out important government spending on things like healthcare and education.
For sure.
So for those of you in Kenya, you should really pay attention to any news about a credible plan to tackle this long-term vulnerability.
Good advice. Okay, moving on to Kenya's foreign exchange reserves. We saw a $45 million decrease, which brought the total down to $9.5 billion.
Yeah.
While this still equals a comfortable 5.1 months of import cover, which is above what the Central Bank of Kenya requires, the transcript does highlight that there's a lot of pressure on these reserves.
Right.
What's causing this pressure?
Okay, so the pressure on Kenya's foreign exchange reserves, it mainly comes from two things that are connected. A constant current account deficit, which means Kenya is importing way more than it's exporting,
Okay.
and the growing burden of those external debt repayments.
Right.
This combo creates a continuous drain on the country's foreign currency holdings, and that raises concerns about a potential sovereign debt default somewhere down the line. And the fact that the CBK's weekly bulletin didn't explain this week's decrease, that just adds more uncertainty to the situation.
Got it. Now, turning to the money markets in Kenya, it seems liquidity was good during the week, helped by the CBK's active use of open market operations. The interbank rate stayed pretty stable, and the average value of transactions actually went up. Excess reserves held by commercial banks also looked healthy.
Okay.
So, at least in the short term, it seems like the financial system is running smoothly.
Yeah, I'd agree with that. That stable interbank rate, which is the rate banks use to lend reserves to each other overnight, and the good liquidity, those are positive signs about the short-term health of the money markets. Think of the CBK like a plumber for the banking system.
Okay, I like that analogy.
When there's too much water money in the system, they sell pipes, government securities, to soak it up.
Mm,
And when there's not enough, they buy pipes to inject more liquidity. The fact that there are healthy excess reserves beyond that cash reserves ratio, CRR, which is like a reserve tank that banks have to keep at the CBK, that means banks have more fuel to potentially lend to businesses and individuals.
right, that makes sense. Okay, let's look at the government securities market in Kenya. The weekly Treasury bill auction, the bids actually fell short of the advertised amount, although the CDK still accepted a big chunk. And we also saw slight drops in the rates for all the different T-bill maturities.
Interesting.
So what does this tell us about how much investors want those short-term government debt and the government's cost of borrowing?
All right, so the fact that the T-bill option underperformed, with bids not fully meeting the amount offered, that could suggest a few things. Maybe investors are being a bit cautious, or maybe they'd rather invest in longer-term securities. This slight dip in T-bill rates, that means the immediate cost for the government to borrow through these short-term instruments has gone down a tiny bit, which could be a small relief.
Yeah.
But the bigger picture might be in the primary bond market. The CBK has announced they want to raise a whopping 70 billion Kenyan shillings through new bond issues to help fund the government's budget.
Wow.
And the fact that they're offering bonds with pretty high coupon rates ranging from 12.75% to 14.18%, that reflects the perceived level of risk and the need to attract investors in the current environment.
Absolutely. Those are some significant rates. And finally, for the Kenyan markets, the Nairobi Securities Exchange had a mixed performance. Some indices gained a little, while others saw small declines. Year to date, the NSE 20 index is still the strongest performer. It looks like gains in big stocks like Safaricom and a few banks helped lift the market, while losses in other large companies like DTB Bank and EABL pulled it down. So what's the main takeaway from the NSE's performance this past week?
Well, that mixed performance on the Nairobi Securities Exchange, it kind of suggests that the market might be in a period of consolidation after those earlier gains.
Right.
The fact that major, well-established players like Safaricom contributed positively, that shows they still have a big influence on overall market sentiment. Those losses in other large-cap stocks could be because of things specific to those companies, or maybe some investors are just cashing out on profits.
Yeah, that makes sense.
While the year-to-date performance still generally looks positive for most indices, this recent volatility, it's something to keep an eye on.
Okay, good to know. Now let's dig into a big issue for Kenya this week. The country's request for a new funding program from the International Monetary Fund, the IMF.
Right.
It seems Kenya didn't hit some revenue targets under the current program, and that means they didn't get the final chunk of funding. The government is saying it was a mutual agreement to end the program because of timing. But what's the real story here?
You know, what's interesting is the difference between what the government is saying and what probably really happened. While it's true that the previous IMF program was ending in April 2025, the fact that Kenya didn't meet those agreed-upon revenue collection targets, that's a big deal.
Yeah.
And that's probably why they didn't get that final $850 million installment. IMF programs have specific conditions that countries have to meet to receive funding, and if they fall short, the IMF often holds back the money.
Right.
So when the Treasury Cabinet Secretary says it was a mutual agreement because of timing,
Yeah.
I'd take that with a grain of salt.
Okay. And even though there was this hiccup with the previous program, Kenya has already formally asked for a new lending deal with the IMF. The IMF has confirmed they got the request.
Yeah.
So what could this new application mean, especially considering what happened with the last program?
Well, the fact that Kenya is already asking for another IMF program, that really shows how much they depend on financial support from these international institutions.
Yeah.
But those missed targets and the fact that they didn't get the final funds from the last program, that's definitely going to be a big focus when they negotiate this new agreement. The IMF is going to want to see a clear and believable commitment from the Kenyan government to deal with those budget deficits and the problems with revenue collection that messed things up with the last program.
Right.
They'll be looking for real plans and proof that Kenya is actually implementing them.
Got it. And this is where those comments from S&P Global Ratings become super relevant. They've warned that these missed IMF payments could make it harder for Kenya to lower its debt costs and might even delay funding from other international sources. So why is it so important for Kenya to have the IMF on board with their financial strategy?
Okay, so if we look at the bigger picture, Getting an IMF funding program is like getting a stamp of approval, a vote of confidence in how a country is managing its economy and its reform efforts.
Right.
And that seal of approval can then open doors to other important funding sources like loans from the World Bank, agreements with other countries, and even attract foreign investment.
Makes sense.
As S&P Global Ratings pointed out, any negative signals from the IMF, like not completing a program or delays in a new one, can definitely put those planned borrowings from other institutions at risk, including those huge amounts expected from the World Bank and the UAE in the first half of 2025.
Right. That's a lot of money on the line.
Exactly, and that raises a big question about whether Kenya can actually finance its budget and manage its massive debt without this crucial support from the IMF.
Okay, so it sounds like the stakes are pretty high for Kenya with this new IMF application. A successful negotiation and a real commitment to fixing those past problems, those are going to be super important for Kenya's economic stability in the near future.
Absolutely. The terms and conditions of any new IMF program and how the IMF views the Kenyan government's commitment to implementing those fiscal reforms, that's going to be watched very carefully by investors, credit rating agencies, and those other international lenders.
For sure. All right, let's quickly recap the key takeaways from this week's deep dive. Globally, we saw that worrying mismatch in the U.S. economy with higher than expected inflation happening at the same time as declining consumer confidence, and that's fueled fears of a possible recession. President Trump's announcement of those new tariffs, that's added another layer of uncertainty to the global trade scene, contributing to a stock market sell-off, while gold prices surged as investors looked for safer places to put their money.
Yeah, and in Kenya, we saw a relatively stable shilling in the short term, but those concerns about the high national debt, they're still there. There's also that ongoing pressure on the country's foreign exchange reserves. The Nairobi Securities Exchange had a mixed performance. And crucially, Kenya is now trying to get a new IMF funding program after having trouble meeting the targets of the previous one.
Right, so for you, the learner, thinking about how all these global and local factors are connected, and especially considering how much Kenya relies on international finance, what should you be paying the closest attention to in the coming weeks and months? Maybe it's how those negotiations with the IMF are going, or any new signals about what's happening with the U.S. economy and global trade policy.
Yeah, those are good indicators to watch.
It definitely feels like we're in a time of heightened economic uncertainty, both here in Kenya and around the world.
Absolutely.
So stay informed, stay engaged, and we'll be back next week to unpack more of what's happening in the world of finance.
See you then.
All right, take care.